Good morning, everyone, and welcome to Weekly Profit Talk. As you might gather, we do this every single week on Wednesday at 8:30 a.m. Mountain Time in the Standard Time Zone. We're no longer in daylight savings time, so getting dark at 5 o'clock. Yes, 8:30 a.m. Mountain Time is 7:30 on the West Coast and 10:30 on the East Coast. We do this every single week, and what I'd like to do is talk about the things that affect the bottom line of your tax practice. This week, I want to talk about something that's exciting for me, and I'm looking into this myself, and I want to share because the question comes up from my physician practitioners all the time, and that question is, what can I do about all the tax I pay? Um, this week's topic is why smart doctors should invest in rental real estate. Um, I've got some very good reasons for this. Three in particular are standing out for me, and I'm going to go ahead and let's show you the first one here. The qualified business income deduction. Remember that 20% qualified business income deduction that when you started making over $500,000 with your practice, you're no longer able to take. Now you may be scratching your head going, but I'm my first couple of years in practice and I get all of mine, but of course I only make $300,000 a year. Simply SSTBs, which are specialized service trades and businesses, and there's a handful of them. I happen to be in one in accounting. Doctors are in another one. There are several other people. I know architects and recording musicians, some others, lawyers. And for us folks, if you're married filing joint, the phase out begins in the low to mid 400,000 range, and you're phased out of the qualified business income deduction entirely at about 538,000. I should know that exact number. 2025 is about to end, so I am going to look that up real quick. I will tell you just a moment here. And I'm sorry, it's actually a little bit lower than I thought. You're actually completely phased out of it at 494,600. So call it a 500,000. What do I mean by this? If you have taxable income after all your other deductions, um, that is greater than that $494,000 mark, you are disqualified from taking the qualified business income deduction. And that could be big, especially if that's most of your income. Now, if you're making under 394, let's say 350, and let's say, for example, I'm thinking maybe 250,000 that is net income from your practice. Okay, so that's 250,000, 20% of that amount is $50,000, and you get to take that as an additional deduction on top of your standard or itemized deduction, and it reduces your taxes considerably. So that's why the QBID is a big deal. You can't take it if you're making over 500,000. So sorry. I'm in the same boat. I empathize. I think it's a lousy rule, but I'm not in Congress, so it wasn't my fault. So anyway, your rental real estate venture, however, you just need to check a box that you are doing this as a business, which naturally you're going to do. And any money that you make from disqualified business income is going to, in fact, qualify for the business deduction. It is not added to or aggregated to your other forms of income, including your practice. So um, if you manage to take in, this is kind of a hallelujah number, but let's say you've got rentals that are taking a total of $20,000. Well, you're going to be able to write off 4,000 of that, or 20%. So the QBID is back if you use it. So now the next one really excites me because this is where you're actually going to get a break from the IRS if there is such a thing. So let's get into it. Depreciation. When you buy a home, and it's an investment property. One thing is, and I'm finding this out, is that they consider this slightly riskier, so the interest rates are a little bit higher, but it all comes home for you because you are able to write off the total cost of the acquisition of that property or its fair market value, but usually the first thing because you're purchasing it and you're putting it into service as rental real estate. So let's say, for example, you paid $300,000 for that home, you got another, though, couple $1,000 in closing costs by the time everything's done. So 302,000, you divide that by 27 and a half, and you're going to have an amount that you're able to write off every single year because you spent the money once. It doesn't matter if you financed most of it or not. It's still a cost of acquisition. You get to uh, depreciated over that period of time. I've got an example written here. 300,000 bucks even is close to $11,000 a year. This is what's known as an intangible expense, meaning you're getting to write off $11,000 that you're not actually spending as a active cash flow from your business in the year of the tax return. So that alone, um, consider also if you've got a mortgage on the property, and chances are you will, you're also getting to write off the interest. And what do mortgages do in the first few years? They charge you more interest than principal. If you've ever seen an amortization table, interest is skewed very high and principal is very low. And then there's a teeter-totter balance where the principal starts getting higher. I'd say about year 16, 18, I'd guess, somewhere in there. But for the first few years, you're writing off the interest on your mortgage, as well as all the other expenses. If you have a property manager, which I highly recommend, you don't want to do that yourself. You've already basically running a very busy practice. And chances are, especially if you're married, filing joint, you may have kids. I know that that's a demand on your time and you want to spend time with your family. That's why you're working so hard in the first place. You don't want to spend time taking tenants' phone calls and doing all the placements and running the background checks and all that stuff. Get a property manager. It's worth every penny you pay, but it is also a tangible and reasonable expense of your business. So you get to write that off as well. So by the time you write off all these things, minus the depreciation, there's actually a phrase, it's called EBITDA, earnings before interest, taxes, deduction, or amortization. And your EBITDA should actually leave you some money left over, which is good because you may have sudden emergent expenses, such as water heater goes out. Who's going to fix that? You are. So that's a good thing too, because water heaters, unlike the property, you can write that off over a 5-year period, depreciate that. So, and bonus depreciation's back. That's right. You can write off 100% of that, provided that you qualify for it by all other income parameters. So, unlike the property itself, small improvements, roof, appliances, that sort of thing. This is a thing we call cost segregation, and it can save you a ton of money on taxes as well. So, basically, there's a very good chance that you're going to be filling out a rental real estate attachment to your Form 1040. It's on the first page of Schedule E that actually shows a small loss because of the depreciation, even though you might actually be putting several $1,000s aside in actual cash. So this is why I love rental real estate as an investment. It actually pays you on your taxes as well as paying you in your pocket cash. And the third most important thing is that real estate in probably, and I'm going to throw a spitball number out here. There's nothing backing this up, but I would say over 3/4 of the country, real estate appreciates over time. It's stagnating here in Colorado Springs area where I live, Pikes Peak region, a little bit. It's kind of been hanging in there. My home in particular hasn't really gone up or down in value in a couple of years, but it'll happen because inflation happens. And if you think there's no inflation, go to the Consumer Price Index website and check it out. Yes, there is inflation. Matter of fact, it's a little higher than it was this time last year. So anyway, you can profit cash and still report a loss, reducing your entire tax bill, just like I said here. So that should excite you. It definitely excites me. Last thing is Section 1031. This is where you are able to sell an investment property. And as long as you identify a new property for sale within 45 days and close on that property within 180 days, you can defer all of the gain on the sale of your investment property. Now, let me talk about what that means. Anytime you sell an asset and you make more money on it than you paid for it, you have what's known as a gain. So you buy a $200,000 property, you sell it for $250,000, you got a $50,000 gain. You pay tax on that gain. Okay. But if you put that equity that you made into the down payment of a new, more expensive home, and I think, for example, I put 200 to 400 here. You'll have no tax bill at all if you follow the rules of Section 1031. So, what this does for people building a real estate investment portfolio is it gives you the opportunity to increase your holdings and the value of your holdings and defer your taxes indefinitely, as long as you hold on to your last property or continue to identify new property within the timeline parameters. You're good to go. Now, I said here, warning: once you, yikes, sorry, once you cash out without an exchange, then you're going to have a gain situation, but plan for it. Let's say, for example, you make the sale in May. So you're still going to have three estimated tax payment deadlines between the end of the year and the time that you actually file your taxes, June, September, January. If you know you're going to owe another $8,000 in tax, then get $2,600 each of those periods paid into your estimated taxes and ensure that they're covered before you actually file. You should never owe more than $1,000 when you file your tax. If you're going pop-eyed on me and saying, how the heck do you do that? We need to talk. I can show you how to do it. Okay. So, with that, I hope you enjoyed this and you found it useful. I love talking about it, and I'm probably going to get back around to it again. So, until next week, I hope you're having an amazing day so far and you have an incredible weekend. You continue to stay warm and safe in this lovely fall weather we're having. I'm getting kind of lucky here. It's been sunny, but it is cooling down. So enjoy your November, and I get excited about turkey in 10 days. I certainly am. We will be back next Wednesday. Until then, have an amazing day. And if you have a chance, do something randomly kind for a stranger.